The S&P 500 closed at an all-time record high on Monday morning. The S&P 500 closed at an all-time record high on Monday morning. 7,173 points, a new high. The day after shots were fired at the President of the United States. Let that sink in for a second, because that number tells you everything you need to know about how this market actually works, and how most investors are completely misreading this moment. I want to walk you through exactly what happened, what the data says, what the actual risks are right now, and where prepared investors should be focusing. Because there are two very different conversations happening. There is the emotional conversation on social media, and then there is the conversation the market is having in silence, through price action, through earnings, through oil, through the Strait of Hormuz. Those two conversations are not the same. And if you are confusing one for the other, your portfolio is going to pay for it. Here is what happened. Saturday night, April 25th, 8:40 p.m. Eastern Time. The White House Correspondents' Dinner at the Washington Hilton. Trump, Melania, VP Vance, the full cabinet, all present. A suspect, Cole Allen, 31 years old from Torrance, California, runs through a security checkpoint holding a shotgun. One Secret Service officer was shot in a ballistic vest, expected to recover. No other injuries. Everyone evacuated safely. Allen was charged this Monday with attempting to assassinate the president. This is confirmed. This is not conspiracy. This is federal charges. Now here is a detail that hit me immediately. The Washington Hilton. That is the same hotel where John Hinckley shot Ronald Reagan on March 30th, 1981. Same building, 45 years apart. And I want you to hold that fact because we are coming back to it. Because what happened to markets after Reagan matters enormously to what you should be thinking about right now. And this is the third attempt on Trump in under 2 years. Butler, Pennsylvania, July 2024. A second plot after that. And now this. 3 times. So if you thought Saturday night was an isolated event, it is not. This is a pattern of escalating political instability in this country. And yet, the market closed Monday at a record high. How is that possible? How does the market look at that and say, record? Because the market is not emotional. That is the entire point. The market is not a human being sitting at a desk watching the news and panicking. The market is a mechanism that aggregates millions of positions, millions of earnings estimates, millions of growth projections, and spits out a price. And right now, that price is telling you something very specific. It is telling you that the fundamentals underneath this market are strong enough to absorb political shock. That does not mean you should ignore the risks. We are going to talk about the real risks in a few minutes. But the first thing you need to do is separate the scary headline from the actual financial story. Nvidia was up 4% Monday. Micron was up 5.6%. Alphabet was up 1.8%. The Nasdaq closed at a new record, 24,887 points. These are not the numbers of a market that is scared. These are the numbers of a market that has already processed the event and moved on. And before anyone says this is unusual, it is not. Pull up the chart from March 30th, 1981. Reagan gets shot outside the Washington Hilton. Markets close early that day. The S&P 500 fell 0.27% on the day of the shooting. That is it. The next day, it was up 1.28%. And in the days that followed, the Dow rose more than 7%. 7%. After a presidential assassination attempt. Now jump forward to July 13th, 2024. Butler, Pennsylvania. Trump is shot in the ear during a rally. By Monday, 2 trading sessions later, the S&P 500 and the Dow were both at new record highs. Bitcoin was up 5%. The market shrugged off a sitting presidential candidate being shot completely in less than 48 hours. And yes, JFK was assassinated in 1963, and markets fell around 3%. But they recovered to new highs within days of reopening. The one outlier is Eisenhower's heart attack. But that happened during an already volatile, high-fear market environment. Different setup, different outcome. This is the pattern. In a bull market with low volatility, with strong fundamentals underneath, political violence does not break the market. The variable is not the political event. The variable is the market environment when the event happens. And right now, the market environment is strong. Here is why. We are in the sixth consecutive quarter of double-digit year-over-year earnings growth. Let me say that again. 6 straight quarters of double-digit earnings growth. Right now, 84% of S&P 500 companies that have reported Q1 2026 results beat earnings estimates. The blended growth rate is 15.1% year-over-year. The full year 2026 projection from FactSet is 18.6% earnings growth. This is not a weak economy with a fragile market propped up by hope. The underlying business results are coming in above what analysts expected again and again, quarter after quarter. The S&P 500 is up 8% in April alone. Goldman Sachs has a median year-end target for the S&P of 7,650. That is another 8% from current levels if that plays out. Now, I am not telling you Goldman is always right. No analyst is. But the direction of the data, earnings beats, revenue growth, AI infrastructure spending still accelerating, that picture does not change because someone tried to shoot the president at a hotel dinner. But here is the part people are not talking about. And this is important. I want you to stop for a second, because the shooting is not the risk I am watching. The risk I am watching is the Strait of Hormuz. Here is the thing. Trump scrapped Iran peace talks the same Saturday as the shooting. The ceasefire extension is fragile. The strait is still disrupted. 6 oil tankers transited on a recent day where previously hundreds would move through. And Goldman Sachs has now raised its Brent crude forecast to $90 a barrel for Q4 2026. Right now, WTI crude is at $96.68. Brent is near $98 to $99 a barrel. Think about what that chain means. Oil stays elevated. Shipping costs stay elevated. Airlines feel it. Food distribution feels it. Anything that moves from one place to another feels it. Inflation expectations start creeping back up. The Fed, which was already moving carefully, starts delaying rate cuts even further. And then suddenly, that forward PE of 20.9, which is already above the 5-year average of 19.9 and above the 10-year average of 18.9, starts to look even more stretched. The Bank of Japan just cut its growth forecast for fiscal 2026 to 0.5% and raised its inflation outlook to 2.8%. Global tightening pressure is still present. This is not a risk-free environment. The gun was scary in the moment. The oil price is what can actually hurt your portfolio over the next 6 to 12 months. That is where your attention belongs. Now let me show you the valuation picture honestly, because this is where I refuse to spin you. This market is not cheap. Pull up the CAPE ratio. It is sitting at 40.1 right now. The last time we were at this level was 1999, right before the dot-com crash. That number deserves respect. The forward 12-month PE is 20.9. Above both the 5-year and 10-year averages. The trailing PE is 28.1. These are not bargain bin numbers. The S&P 500 has returned 300% over the past 10 years, total. This is a market that has already run very hard. And here is where I want to be careful, because there are 2 wrong ways to look at this. The permabull looks at that and says, ignore it, just buy. AI is changing everything. The permabear looks at that and says, 1999, sell everything now. Both of those are emotional responses dressed up as analysis. The honest answer is, valuations are stretched, earnings growth is real and accelerating, and the gap between 1999 and today is that the companies driving this market, NVIDIA, Alphabet, Microsoft, Amazon, have actual revenue, actual margins, actual cash flows. This is not .com fantasy. But a cape of 40.1 is still a cape of 40.1. You size correctly. You do not go all in. You do not leverage up. You think in terms of years. Let's talk about the emotional investor mistake because it happened again this weekend. Within minutes of the shooting, social media was flooded with staged. Exactly the same thing happened after Butler in 2024. Same playbook, same conspiracy loop. And some investors, some people watching these events unfold, started asking whether this changes the political landscape, whether this triggers some kind of market crash, whether they should be moving to cash. And I want to ask a simple question. What happened to the people who sold after Butler? They missed the Dow hitting new record highs within 48 hours. What would have happened to the people who sold after Reagan in 1981? They missed a 7+% Dow rally in the days that followed. Every single time there is political chaos, the emotional investor freezes or sells. And every single time, a few days later, the chart does not care. Do not let social media tell you what the S&P 500 is about to do. The S&P 500 already told you. It told you Monday morning at 7,173. So what does the prepared investor actually do this week? First, check your thesis, not your fear. Ask yourself, has anything about earnings growth, AI spending, revenue trends, or business fundamentals changed because of this event? The answer is no. Second, watch the oil situation. That is the actual macro variable that can change the Fed's thinking, change earnings estimates, and change the setup. Watch WTI. Watch Brent. Watch whether the Strait of Hormuz opens or stays restricted. That is your leading indicator. Third, this is the most important earnings week of the year. Apple, Microsoft, Amazon, Alphabet, Meta are all reporting. These 5 companies will tell you more about what this market is going to do over the next 3 months than any political event. Their results will drive more portfolio movement than anything that happened Saturday night. Focus there. And fourth, do not manufacture urgency that does not exist. There is no panic dip here. The market recovered before most people finished reading the news. You are not buying at a discount right now. The S&P is at all-time highs. If you are looking for a clearance sale, this is not it. Now, where is the story actually happening? Let's look at specific names. Nvidia was up 4% Monday. This is not random. AI infrastructure spending has not paused for political events. Demand for GPU compute is still accelerating. Microsoft is reporting this week. Their Azure cloud growth is the number to watch. Alphabet was up 1.8% Monday, also reporting this week, and their AI search monetization story is the thesis to track. Micron up 5.6%. The semiconductor memory cycle is tied to AI build-out, and that demand story has not changed. These are the companies where the earnings results will actually move the needle. On the other side, look at energy. Oil at $96. Goldman raising forecasts. Hormuz still disrupted. Energy stocks are benefiting directly from this geopolitical mess. But I want to be careful here, because this is a trade, not a long-term investment thesis. Oil moves fast in both directions. The moment Iran talks resume seriously, the moment the strait reopens, oil reverses. If you are buying energy stocks right now purely on oil price momentum, understand that you are making a geopolitical bet. That is fine if you know what you are doing. But do not confuse a geopolitical trade with a business thesis. They are different things. Defense is also worth watching. Companies tied to government contracts in a world with an active Iran war and escalating political risk. But I am not going to give you specific price levels on defense names right now, because the situation is moving fast, and I want you to do your own research before touching anything connected to active military conflict. If you want the exact companies I am watching this earnings week, along with the specific levels and data I am tracking, that breakdown is in the Patreon research notes. The link is below. Now let me close with what the chart is actually showing you. The S&P 500 is up 8% in April. It has returned 300% over the past 10 years. It just printed a new record high the morning after a presidential assassination attempt. 84% of Q1 reporters beat estimates. 6 consecutive quarters of double-digit earnings growth. This is the chart. This is the data. But CAPE at 40.1, oil at $96, Hormuz disruption unresolved, Iran ceasefire fragile. Earnings season starting right now for the biggest companies in the world. This is not the moment to go all in. This is not a clearance sale. This is not a panic moment either. Wars happen. Assassination attempts happen. Conspiracy theories explode. Geopolitical crises come and go. And through all of it, through Reagan being shot, through JFK, through 2008, through COVID crashing the market 40% in a month, the S&P 500 has returned 300% in 10 years. Every crisis on the way looked terminal. Not one of them was. The prepared investor does not react to the headline. The prepared investor looks at the earnings trend, checks the valuation, monitors the actual macro variable, and in this case, that macro variable is oil, not the shooting, and builds a position slowly, deliberately, without leverage, without panic. Watch the earnings this week. Watch Hormuz. Watch the Fed language. Size correctly into a market that is at all-time highs and trading at elevated valuations. Own quality businesses. Think in years, not in news cycles. The shooting scared people. The chart did not blink. Know which one to listen to.